Today I would like to analyze Crocs, one of the largest footwear company in the world and one of the worst performing stocks in the last few months. We can see here the stock price is down around 28%, so we're gonna take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 4.71 billion US dollar. This makes Crocs the 12th largest footwear company in the world by the market cap. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2020, the revenue was around 1.39 billion US dollar. This was a 12% growth from 2019. In 2021, we saw the incredible growth around 66%. In 2022, we saw the very strong growth around 53%. Then in 2023, we saw the good growth around 11%. And then in 2024, we saw the decent growth around 3.53%. So overall, I think in the last 5 years, we had a very good revenue growth. So as a check here. The next thing we're looking for is the free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 0.22 billion US dollar. This was an incredible growth around 321% from 2019. In 2021, we saw the incredible growth again, around 127%. Then in 2022, we saw the decline around 2.4%, which is also understandable because the year before we saw the incredible growth already. And if we take a look at the operating cash flow, we can still see a growth around 6% in 2022. So the decline in the free cash flow is partly because of the capital expenditures increasing. So then we can take a look in 2023. We saw the incredible growth again, around 63% in the free cash flow. And then in 2024, we saw the good growth around 13%. So in the last 5 years, I would say we had incredible free cash flow growth. So it's also a check here, and we like to see that. The next thing we're looking for is a free cash flow yield over 4%. This can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for an undervaluation. So we're going to take the free cash flow from 2024, 0.92 billion. Then we're going to divide it with the current market cap, 4.71 billion. And then we're going to get the free cash flow yield for 2024. So the number we're going to get is around 19.53%. And that's actually an incredible free cash flow yield. It's over the 4%, and as you check here, it's already an indication for undervaluation for me. We can also take a look at the future assumptions of the free cash flow. In 2025, it's around 608 million. In 2026, around 631 million. And in 2027, around 597 million. So I think these numbers are quite pessimistic. Let's assume for 2027 we can have around 0.7 billion US dollar. Then we're going to divide it with the current market cap, 4.71. And then we're going to get a different free cash flow yield with the free cash flow assumptions of 2027. So the number we're going to get would be around 14.86%. And that's still a very high free cash flow yield, and also a check here for 2027, and to me is an indication for undervaluation already. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with the free cash flow in under 5 years. A very important number, because if the company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. We can see here around 1.35 billion. Then we're going to add the short-term debt as well. We can see we not have a short-term debt here. So we're going to divide this number with the current free cash flow, 0.92. And then we're going to get the ratio that we're looking for, and that's around 1.46. And I think it's a very good number actually. It means in 1 year and 6 months, we can repay the debt with the free cash flow. So the check here, and we like to see that. We can also take a look at the cash on hand, so how much money this company has in the bank. We can see here around 0.18 billion US dollar. And overall, I think this company has a very good balance sheet, and we like to see that as well. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for an undervaluation. So we want to see a low number here. First, we're going to calculate the enterprise valuation. So this is the current market cap, 4.71 billion. We're going to add the debt as well, 1.35 billion. And then we're going to take minus the cash, 0.18 billion. And then we're going to get the enterprise valuation, so how much the whole company is worth. So the number we're going to get would be around 5.88 billion. So now we're going to divide this number with the current free cash flow, 0.92 billion. And then we're going to get the ratio that we're looking for, and this is around 6.39. And that's a great number actually. It's under the 25 that we're looking for, and to me it's an indication that this company is extremely undervalued right now. We can also calculate this number for 2027 with a more pessimistic free cash flow assumptions. So this is the assumptions of 0.7 billion in free cash flow. Then we're going to get a different number. So the number we're going to get then would be 8.4. But again, a very low number is under the number 25. Is also a check here for 2027. And again, an indication for undervaluation right now. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially we think the company is undervalued. So we're going to take a look here and we can see this company buys back a lot of their shares. We can see in 2015, close to 10% of the shares outstanding decreased. In 2021, over 11%. So they're buying back huge amount of shares, and this is something very positive if this company has a good balance sheet, and they have a good balance sheet so they can afford it as well, and the shares outstanding decrease can help the stock price to increase. So this is something very positive overall, and we like to see that here. Can Crocs stock be a good buy right now? The stock price is down around 28% in the last few months. So let's start with a positive about this company. I think this company had a very good revenue growth in the last 5 years. I also think this company had a very good free cash flow growth as well, and this is something we really like to see. The balance sheet is also looking very good, so we have a low amount of debt and a good amount of cash on hand. The free cash flow yield around 19.53% is incredibly high and already an indication for undervaluation. And with the pessimistic free cash flow assumptions in 2027, the free cash flow yield would be around 14.86%, which is still very high. The enterprise valuation to free cash flow ratio is around 6.39. We like to see that number under 25. So it's already an indication for undervaluation right now. And in 2027, with a more pessimistic free cash flow assumptions, this ratio is still at 8.4, which is still very good actually, and an indication that this company could be extremely undervalued right now. What I also like to see about this company is they have a lot of shares buybacks. I think this is very positive as well because it can help the stock price to increase. So overall, I think this company could be a very good buy right now. So the only negative about this company, in my opinion, it's a clothing brand. So a clothing brand also has a lot of risk. This company had a lot of hype in the last 10 years. We can see the stock price is up over 1000%. So the reason for that is this company had a lot of popular products, a lot of people buying their products, so they have a lot of hype. And this can also slow down. So if less people buying their product because some other products become in the trending, so then this company can face a lot of problems and a lot of risk. So we need to keep this in mind as well. I think clothing companies are quite risky, but overall I think the financials look very good about this company. If you found this video helpful, don't forget to like and comment and subscribe for more content.